Hello fellow traders. Today in this video we will talk about moving averages. I will try to keep a depth in my analysis to people who are already trading or to people who are willing to start. So this considers to be one of the most famous tool you can use, and I will give you all the details in this video. So let's start right away. We have two main categories of indicators. We have leading indicators and lagging indicators. Easy to understand by definition, a leading indicator is used to predict the future behavior of the prices. Lagging indicators offers a historical report of the prices. So the first question that comes up is why to use a lagging indicator? Why to use a tool that can be applied in prices and data that already took place and not a leading indicator that can predict the future? Well, the answer is very simple. The market tends to copy herself. The market tends to repeat herself, but in an unpredictable way. So this means that they are able to identify behaviors and they can predict by using high statistical probabilities, by using historical data. Keep in mind that always prices comes first. What I mean by that is that primes are the primary source of data. I have already opened the Euro USD pair or fiber to start some workings to help you understand and expand your knowledge. I will use the MT4 platform, but is pretty much the same in all platforms. I have already opened the indicator and I have used the period of 100. The first thing that we need to complete as a value is the period that we want our moving average calculator to calculate the average prices. So let's give an example by using the period of 100. The most common values are 15, 20, 30, 50, 100 and 200. We have also several types of moving averages. We have the simple or arithmetic, we have the exponential, the smooth and the linear weighted. Here I have plotted the simple one is the arithmetic 100, and what I want from you to understand is the main idea, and I will give you examples later in this video. Moving average may calculate any given sequential data set. So this means that we can use it everywhere, either to the open prices, to the close prices, to the high prices, or to the low prices. And here comes the first characteristic of this indicator. It can be used everywhere. And when I say everywhere, I mean really everywhere. We can even use it when we want to calculate the average volume of other indicators. And also, this is the drawback of this indicator, because it can turn into a hindsight game, because you do not know exactly from where to start applying the indicator, in what values, to the open values, to the high values, to the low values. Should I use the median price? Should I use one moving average? Should I plot two on my diagram, or three or five? So I apply the indicator, and this line represents the average prices. Start counting from the 100 candle. The reason is that I use the simple arithmetic one, so the indicator will start to work after the period we have started as initial value. So if we use the 50 period indicator, it will start give us prices after 50 candles. If we use the 30, it will give us after 30, and so on. So here comes another issue. Now the indicator doesn't give us an accurate representation. So let's say accuracy for me is not something that we can use as an expression when it comes to trading. in trading, nothing is written in stone, even though there are rules that we will cover in the upcoming videos. So it moves too slow in compare with a price action. So this can be solved very easy by using the exponential one. So I have plotted him on the diagram, and as we can see now, we have from the beginning of the pair, and also we have the indicator that goes with the prices. Now, of course, the first candle is the same with the line, so the indicator will start giving values after a while by giving us the average prices. The bigger the period, the slower the indicator becomes in reacting to prices, and this makes him unable to detect the price changes immediately. We could say that the indicator always follows the prices, and I have said that many times, that always price action comes first. Now we are in the monthly chart, and the prices are from the beginning since the pair started, the Euro USD, in 2000. Well, originally it was an accounting currency from 1999, but we will not go into these kind of details. So we have the full diagram of Euro USD. So every candle is a month. This is for practical reasons, so we don't get mixed with several time frames. I have plotted some basic indicators here, so you will be able to understand with this example. The 31, the 51, the 100, 150, 200, and I also intentionally used one more, the 401, and you will understand why. So the prices, let's say at this point, dropped very fast. The moving average of 30 and 50 almost immediately caught the price. The bigger the period, the slower the indicator becomes in detecting the price. For example, the last one, the 400, actually never got the price. So if we wanted to make a system that generates trade, obviously in this diagram, we could say that the 400 indicator is not so useful, and this is how the trading strategies are born. So you start immediately exclude things that don't work. So in this simple moving average method, we could just go short as soon as our prices penetrate the moving average of 30 or 50 or 100 or 150. Keep in mind that trading is much more complicated than this. We are just giving simple examples. Moving average is a lagging indicator. We will analyzing leading indicators like Ichimoku, Fibonacci, pivot points, and many others in a future video. But for this video, if we want to sum up, a moving average indicator can be used in almost every price. The problem is that can only be used in prices that already took place. He cannot predict the future. The period is also important. The higher the period, the slower the indicator reacts. But let's see why, if you want to succeed in this industry, you must think a bit more. So it doesn't matter if we believe that an indicator or a technical line or a pattern works. It will work because other traders believe so. And keep that it doesn't matter if you don't believe in it, it will work because others believe that it will work. And we need also to combine information. Moving average is the most common tool. Most of the traders use them, and in several analyses you will see that they are mentioned them. So despite the fact that they have many drawbacks, most of the traders use them. So it's really important to know what other traders will do in a given market price action. So you must think differently if you want to succeed, and you must be creative with your system. Now let's see if we can give an example and if we can become more creative. So I have used the same moving averages in this example. We are still in the fiber, and I have plotted the averages but without using the exponential moving average. I'm used the normal one because I don't want to mess with the prices. I want the real prices since the pair started. Now what I did is I used the shift option. So I used the value of 12 because each candle is 1 month. So actually we have 12 candles for a year. And I tried to shift the indicators to the future. So actually now, even though we had an indicator that it was really a mess, it was just calculating the prices or historical data that already took place. Now I turned him into a leading indicator. So actually a simple moving averages combined together can give me an approximation of the upcoming prices. Keep in mind that I have used these vertical lines. Each line represents a year. So if there is any seasonality or periodicality, then probably we'll be able to make very accurate predictions. It won't work. It doesn't work. This is just an example. I'm always giving you my real account so you can see the changes and the trading method that I am using. So make sure you always do multiple tests and tries, and trade safe. See you around.